of the India Economic Summit organized by the World Economic Forum in New Delhi. CNBC TV 18 brings you the stalwarts of India Inc. Let's get across to Ronajay Banerjee, who's in conversation with Shikha Sharma.
Interest rates coming down, we are not going to see that impacting either asset quality or investment appetite. And the government's done a lot of stuff around inflation management as well. We've been lucky with oil prices coming down, and that's helped on inflation. But I think a lot of the government action around the food supply chain and trying to come down on speculation, being realistic about MSPs, a good monsoon, I think all of that is helping food inflation. So we are hopeful. We are hopeful that as long as RBI follows an easy liquidity policy, that all of this should translate into interest rates coming down.
Vineet Nair was here from Tech Mahindra, and he told me that how the RBI may have missed the bus last year when the oil prices were coming down, and at that point interest rates continue to be high. And he said that the real effective interest rates for companies like his is over 10%. Do you think that was a missed opportunity?
I think there's no much point looking at the past, but the fact is that yes, we had a big disparity between CPI and WPI. So CPI was running at whatever 6% and WPI was negative. So the policy was targeting CPI and not WPI. So companies got hurt massively because they were experiencing negative inflation, but interest rates were hugely positive because we were targeting a real positive return on CPI.
Right.
What's happening now is that CPI and WPI are aligning. And the fact was that CPI is getting impacted by not just monetary policy, by a lot of real world actions. Food inflation in particular, so stuff that government has done around that has helped food inflation. So I think some of this will correct, and also RBI becoming a bit more pragmatic in saying what the real return target needs to be and aligning it a bit more with what global numbers are around.
But how far are we, ma'am, when you speak with your borrowers? How far are we from the private investment cycle picking up? Because recently, CMEIE came up with the data and they showed July to September quarter. Again, both public and private projects had seen a big decline. What's your sense, ma'am?
So capacity utilization is still running at about 72-73%.
Absolutely, yeah.
Unless that picks up, I think investment cycle is not going to pick up. So we have to watch that.
So do we have to worry? Because in a country where over 80% of investments are led by the private sector, and you're saying we're still far away from that private investment cycle to be revived, costs, I mean, there's still cause for concern from an economy standpoint.
Yes, clearly, I think we are a couple of quarters away from the private investment cycle coming through. But I think the government is trying to push through public expenditure, and especially in the infrastructure sector, given the experiments with PPP, some of which have worked, not worked, I think there is a case for government spending kickstarting private sector spending this time around.
Couple of last things, because the other issue that the Cs were telling us, that apart from the cost of funds being an issue, is also the over-leveraged balance sheet. How long, ma'am, before the shadow that the NPA has cast over banking and sort of financing passes over?
So, I would really argue that it's not banks' ability to lend which is holding back private investment. It is private entrepreneurs' willingness to go out and invest. So in a scenario where capacity utilization is low, growth is picking up slowly, and interest rates are high, and there's a lot of global uncertainty, we're not finding companies lining up to say give us loans and we are not giving loans. That's not the scenario.
So you're not. So the risk appetite is still very, very low.
Exactly. So it's not about bank balance sheets. It's about real risk appetite in the real world. I mean, show me the number of projects who want funding and haven't got it.
But what about the NPA, ma'am? How long do you think before? How are you dealing with it at your end?
So the NPAs are coming primarily from two factors, as I've talked about in the past as well. One part is because of projects which got stuck, so whether it's power projects or road projects which got stuck during implementation. Two has been the commodity cycle, and three has been this phenomena of low growth coupled with high interest rates. So on all three, I think we are seeing progress in the right direction. The government's taken a lot of initiatives to try and debottleneck some of those projects. On the steel sector, again, the government's taken initiatives to try and help the steel sector, and the commodity cycle seems to be turning from a price perspective as well globally. As far as the growth inflation dynamic is concerned, if RBI is going to be a bit more balanced, hopefully we will correct that dynamic. So all of these three have to really play out, and that will take its course in terms of bank balance sheets.
All right, so we'll get you more snippets from that